All right, what's going on, everybody? TGIF, right? So on Wednesday, we took a look around near the end of the stream and pointed out that while we had a few little weak signals, we really didn't have anything that said short this market. And that continues to be proven out. We're not breaking down, really struggling to get going and really get anywhere, but we're not breaking down. So we still don't have major signals telling us that it's time to get short this market. Individually, of course, we can always find something to go long or something to go short because that's just the way it goes. But if we're looking for like short at will and size up on some shorts, we don't have no signals for that. The bull bear scan really isn't offering all that much either. Earlier today, like say 10 during this push especially, there was a lot of names, and retail was getting whacked. We saw it earlier this week, really pushing, and then it was getting hit. They're still in there a little bit, like Dollar General's still in there, but not as much as it was. And finance was doing good. Nasdaq wasn't. So if you were looking at the kind of detailed advanced decline, you could see that the Nasdaq 100, while it has less names going down than up, there is more capital going out than in, right? You can see 3.1 versus 2.5, 100,000 million billion. Earlier, it was obviously it was in the millions, but either way, that's a discrepancy and it's a warning to be careful. But, if you get enough shorts, longs are a great trade because you just squeeze those shorts and make them puke. So we got some topic requests for today. One of them is to talk about the types of trading days and being able to spot those different trading days in advance before the day opens. I've shared the book. You can just run a search in Discord in the upper right corner, Secrets of a Pivot Boss. I I've shared it so many times it shouldn't be that hard to find. But if you can't find it, let me know. We'll share it again. This book is really what highlighted the idea that there were these different kind of days. And as usual, with the way things usually go when it comes to how I've learned to trade, I did all the work myself and found these unique days and then researched them and dug deeper into them and had my own style for finding in advance what kind of day we were going to get. And then after I did all that work and put it all together, I found a book where somebody else had done it and they were using a different approach. So I guess, the moral of that story is that it's very rare that you're going to come up with something new in the market that somebody else hasn't already thought of. And before you go and dig and dig and dig and do all this work, just poke around and see if you can't find that somebody else has already done the work. I can't tell you how many times I keep screwing this up and doing it the hard way just to find out that that work has already been done somewhere. Sure, it makes me better, right? And you would be better if you make your own stuff, but it's still a lot of work. So this Discord that we're looking at right here, this is one that I had built for range and trend because at the time when I built it, I was trying to figure out if today would be a range day or a trend day before the bell even rang. And I had come up with checklists and various techniques to try to identify in the pre market which one of these it would be. And then to be able to circle back and kind of check the box through the morning session on, hey, what are we getting right now? And if it hasn't yet begun to be a breakout, what are we going to need to get that breakout? So, as I've mentioned before, creating your own Discord is one of the best things that you can do if you're trying to learn how to trade. There, so far, there is nothing else that I've ever come across that can help you become better at trading. I create a Discord with a particular topic in mind or a problem that I want to solve, and then I start getting to work gathering information and finding spots for it and then processing that information until I finally understand it. And there's so much information out there, right? I mean, there's so much information. And good traders are good researchers. So you have to get good at finding material, you know, utilizing resources on the web so that you have access to college level libraries and research papers done by trading firms, institutions, colleges from around the world, and then looking back and seeing if anybody has done any work that is focused on the topic that you're trying to learn. The other topic, which I think we're going to start with because it'll be faster, is spotting reversals on the day. Now, we can spot where reversals are supposed to be. That doesn't necessarily mean that we're going to get it right every time, right? Because well, we can't predict the future, and there's just no way to know for sure that price is going to turn where we think it's going to turn. But on the whole, we can usually spot where price is likely to turn next. And if it doesn't turn there, then we spot the next place and focus on that spot. And then there are patterns and signals that we look for that also help us with this. I should have left that Discord back up there for a minute. There is a sticker that I built, a while back that I like to post in the chat sometimes. This sticker right there. And I made this sticker. It was one of the first stickers that I'd ever made that was an animated sticker. I was so proud of that little thing when I made it. It takes a lot more work to build those than I thought it would be. But I made that little sticker because it is one of the best reversal trades that I have in my arsenal, and I use it y- on some of my best trade strategies, like yesterday's 111, or you know, inside day breakouts that fail. So it's a 3 bar play or a swing low, however you want to play it. And if you're looking at it from a daily, it would be like a hold candle or a drop base rally pattern. But either way, it's a reversal pattern. And if you didn't catch that, I just named like 4 different reversal patterns, right? So when we're trying to spot if or when price is going to turn, yeah, it helps to have levels to focus on and measured moves and quadrant lines and boxes and pivots and Linreg levels, but it also helps to understand what reversal candles look like. Head and shoulders, for an example, is a reversal pattern. So inverse head and shoulders and regular head and shoulders, those are both signaling reversals. Then you've got things like a cup and handle. If you think about the way a cup and handle forms, it's a failed bear flag, right? So you got the flag pole, and flags are supposed to go lower. So if it fails, it doesn't go lower, it ends up coming back up, and that creates a cup. Then, of course, you get the 786 pullback on that cup, and that gives you your handle, and then you've got your next run to the upside. So trying to anticipate what price is going to do oftentimes lines up with what's the bigger pattern, so that when you're looking at price, you're not just focused on what are these particular candles doing right here with this little flag that ended up failing and we came back in, or here where we had a flag that failed and we came back in, but instead focusing on the bigger pattern being able to recognize, for an example, that we had an entire flagpole here. This time frame isn't really a good example of that, but there's a flag, or that there's a big head and shoulders, so that when we get to the measurement for that price pattern, you have a good idea of what's supposed to happen next. It's supposed to turn there, bounce there, and how far it's supposed to go. So some of the common ones where we see price turn and where we should expect to see turns is on open, high, low, close. They are my favorite pivots. There's a lot of indicators that use those, including floor pivots. And it's where you see price turn a lot. If you go out to a daily, and I've done this kind of work before, it's kind of tedious after a while, but when you first start doing it, it's kind of neat. Go out to a daily and just zoom in a bit so you got a really clear idea what you're looking at. You can even take pictures and then do them in stages, focusing on where we closed and how that relates to the previous high, low, close, and open. It's so easy just to bring up a chart and look at how price presents itself, how big the bars are, where the wicks are. But until you get to the point where you're really paying attention to where candles opened and closed and how high they went, so that when we look back, we can identify multiple places where price overlapped in a close or in an open or against a high, then you start to get a different bit of insight on what price is doing and where it's likely to go next, where it's likely to stop. Like here, for an example, where we had set that high, and that was a high that had exceeded the previous high. It's using the wrong box there. So we wicked out and failed, and we dumped that day. And we actually ran all the way through and broke out of the bottom of this box. So we had it on both sides. And then we ran back up and broke out and closed after rejecting that level. Once we had the breakout started of the previous day's range, because this is an inside day breakout, we bounced on the mid, although maybe not the mid, right? RTH mid, let's say. We bounced, started running, got an inside day breakout, and we were going. Now, it took all day to get there, so we really didn't get a chance to turn that much, but it wasn't hard to figure out, hey, where we're going. Back to that previous high. If we were wrong, we still would have gotten close. So on the intraday, what I like to do through the day is lay out my targets and my levels and things that we could hit. It's easy to get sucked into the idea that all the information we need is right here on this chart, but that's not exactly true. We need to look left. What did we have yesterday? Open, high, low, close levels. Look at the week. What do we have out on the weekly? The weekly high, open, low, previous week's close. That way, if any of those are going to get hit today, I want to know where they are. Yesterday's open on the RTH and yesterday's open in the Globex. I want the 4 o'clock close, the 5 o'clock close, and the 6 o'clock open marked. Because if we're going to hit any of those, I want to know where they're at. Then I'm more willing to focus on the things that are happening within this chart. Even then, these places where we turn, you ever notice sometimes price will be moving, say breaking out into new highs, there's literally nothing there to hit, and it just turns around and goes the other direction. And you're thinking, what the heck did we hit? There's nothing up there. Well, we didn't hit anything. But I'll use the VIX for a very generic example. The VIX moves opposite of us, right? So if we're going up, it's going down, vice versa. So take that logic and think for a moment, what happens if the VIX is, say, dropping down and bounces off a support level and it starts to rise? We're very likely going to turn around and start to fall. The VIX does not bully us that way most of the time, but I just use it for an example because most people understand that the VIX is moving in the other direction. But it could have been dollar, bonds, yields, treasury, commodities, oil, gold. Anything can bully us and make us move in another direction. It isn't always because traders are trading the thing that we're looking at. Microsoft, Apple, Amazon, the ES, the NASDAQ, whatever it is that you are trading, it's not being moved solely because of people trading in that one thing. You could be trading Walmart, Costco gets its butt kicked, and suddenly Walmart's getting all kinds of flows and it gets ripping because of what's happening to Costco, not because of what's happening to Walmart. It happens all the time. So when price is moving towards a level and you're trying to anticipate, is this a reversal point? Are we going to turn around here? Blah, blah, blah. Try to focus on why are we moving? Is options pushing us in that direction? Is there an alternate market, an inverse market? Do we have, you know, dollar, bond, yields, treasuries, commodities? What's pushing us? Hey, to be fair, you're not always going to find that answer either. Sometimes you look around and you just won't find anything. It happens. But a lot of times, if you look, you'll be able to highlight which side is doing the bullying. By the way, the VIX broke down today and is expanding even lower at a rapid pace. And we're just kind of stuck up here in a 3 bar pullback, not matching that move at all. But with the VIX in the current location and with us with the gamma level that we're at, it's not about the tick for tick move in the VIX. It's more about swag levels at this point. And as long as we're still below, say, 16 and a half, then the VIX really isn't going to be much of an issue to us. It could even start to run back up like it did earlier today in this area here. And it didn't really whack us down. It looked like it slowed us down a little, but I would argue there's probably another market somewhere that did that instead, and that the VIX was just feeling it as well. So you want to study reversal patterns, right? And there's a lot of candle books out there. I think they're boring as hell. I find it really hard to read candle books. They're just so boring. But what's really cool in the modern world that we live in is you can just go to Google and you can type in the candles that you want and put it on image for results. And you can go through all the candle patterns out there visually without ever having to read a candle book. So if we type in something like reversal candle patterns and we look up at the top, it offers us a choice to see the results in pictures rather than in words. And so here is a lot of examples that people have found over the years or made over the years. And some of these are not going to match what you're looking for, right? The one here from the bullish bears, I spot those colors from a mile away. That's just a candlestick cheat sheet. It does not say reversal patterns, right? Which means we'd be getting a bunch of patterns that may or may not fit. This one, however, says reversal patterns. And this one says reversal patterns. So that way, if you don't know any of them by name and you can't search for one particular candle pattern in name form, you can just get a group of them, grab that, and now you've got like a table of contents that will give you a list of reversal patterns that you can go through and start to study. So we've got the kicking bar, inside bars, and outside bars. We would be able to go in and search for any one of those by name and find a lot of examples of that one candle pattern until you get comfortable enough that you think you can spot it on your own. Then it's time for work. You go into the charts, start scrolling back, finding really good reversal areas where price did turn and trying to identify, hey, what candle pattern was there when we got that turn? And if there isn't one, you know, well, I mean, that happens, right? Because we don't always turn because we had some kind of setup. Sometimes we turn because an inverse market moved us. Before I got to the point where I had a arsenal of candle patterns to focus on, instead I focused on if we did get a turn, even if I didn't expect a turn in the particular area where we were turning, what is the tradable opportunity that I like? And I say that because, well, I see one right here, and I really love this pattern. I've talked about it before. Hold, right? It's candle at high of low day. C A and then the word hold. Now, this was designed by somebody over at TD Ameritrade, Connie and Barbara, and it's meant to be done on a daily time frame. But once you see this pattern, it just sticks with you, right? And candle patterns are really cool. They work everywhere. So if this is the low of the run, we had this run to the downside, and then we get this reversal bar, it becomes a trigger when it gets higher than the last bar's high. So that's the high of the low bar. Hold. And that's a tradable opportunity. For your stop, you can go to the low of the range if this reversal bar was smaller. This one's a bit too big for me. I wouldn't want that big of a stop. But you can go to the low, you can go to the open, or if it was moving fast, you could try to catch somewhere in the mid of that last bar, or even hide behind the open of that last bar way down here. Tighten your stop up quite a bit, right? And then, of course, once that candle closes, then you can get your stop above that previous bar's high. And in this scenario, it actually put us into profit. That way, if price comes back down and stops us out, well, we defended it and we got out with profit and we could find a trade somewhere else. The same tactics work for swing, trend, options, stock, futures, doesn't matter what it is, right? We'll never know for sure if price is going to turn when it gets to the level or not. The best we can do is try to identify where those levels are and then understand what reversal signals look like and try to tie in anything else that may become relevant. Like, how did we get there? This one's really important. And it was funny because I was talking to somebody about this yesterday and we were talking about big explosive moves where we go really fast. This is like one time framing, but say it's three really big bars and it creates like a liquidity gap. Base case scenario, we're going to go back and close that liquidity gap because I mean that's what we do, right? In this case, we tried. We didn't get back there, but we at least tried. But once you have something to measure, then you can start laying out your levels. 50%, 100%, even the quarters, 25, 75. So if we had measured that run from high to low, we overshot the mid on the way back. I don't draw my drawings this way, but I wanted to see where the real mid was. That's how I draw my drawings. And the mid that we would have caught, it overshot, but the turn was where it was supposed to be. So start working on reversal candle patterns, finding the ones you want or the ones you like, the ones that you can find most often on the product that you trade, and then develop a trading entry point for when you get those sort of turns. I like that 3 bar a lot, the one that I posted in the chat. It's really one of my favorites. But you got to have something, right? So if you, what do we call it, like lipstick on a pig, if you line out, put your drawings on for open, high, low, close, VWAP, floor pivot, point of control, value area high, value area low. By the time you're done, you've got levels up and down on both sides of price. ADR, right? Now, you can get to the point where you have too many lines, too many drawings, to where it seems like every 5 ticks we're hitting another line. And that just boils down into worthless, right? Because then you don't know what price is going to do. And it just seems like it's breaking everything that you throw at it. I get that. But some of the key ones that will always continue to circle back are the open, high, low, close, and the floor pivot. And then, oh, and volume profile, point of control, value area high and low. Those are key ones that just keep coming back over and over and over again. The additional ones that you can add, like true close, 5 minute low, 5 minute high, half back levels, 111s, 1, 2, 3, 6s, those are helpful to be sure, but they're secondary to the institutional levels that we were talking about. What's up, buddy? You can add more. I know that there was a question this morning about the combo levels, and we can add more and more and more levels. The institutional ones are fantastic. They're a really great way to start, but you can add in combo levels and call walls, put walls, just about anything you could want, and it becomes more and more and more noisy to the point where you're just like, I can't see anything in this thing. It's just such a mess. And I have talked to people more than once about pivots when they say, wow, these pivots are really awesome. I want to do more of this. And then we start talking about it, and their entire plan is I'm going to find a pivot. And when price gets there, I expect it to turn. I expect that trade to be a reversal right there because it's 111 always. So when it gets to 111, I'm shorting it, or it gets to 111 and I'm going long. That's their whole plan. It's just, it's going to get to that pivot and I'm going to put on the trade going the other direction. And then, of course, that doesn't work. And they say, I just can't get it figured out. I don't know what to do. Sometimes it works, sometimes it don't. When should I short it? When should I not? It got to the level, and what am I supposed to do there? Take the bounce, not take the bounce? And it really defeats the purpose, right? That these levels are not your trading plan. They are just areas of interest. And when price gets there, one, you should have a plan about what you expect to see when price does get there. It shouldn't be a surprise like, oh damn, we got to yesterday's high. I guess I better short that sucker. Right? You should have seen it was going to yesterday's high 3 hours ago and have a plan for, hey, if it does get to yesterday's high, what exactly am I going to do with it? And as it gets closer to yesterday's high, check bonds, dollar yields, commodities, options flow. Look at the other markets. If you're in the ES, look at the NASDAQ, blah, 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 because you have time. It's price ain't sneaking up on you. And then you'll have a plan that says, this time, because of all the things I looked at, when we get to yesterday's high, I think it's going to be a reversal. And so I'm going to prepare for a reversal trade. Or it's getting to yesterday's high. I've done all my work, and it looks like when we get there, we're very likely going to break through it. And so now I want to look for continuation trades rather than reversal trades. If you approach pivot point trading like that, you'll find out it tends to work a lot better. So with reversals, hopefully we got a good start here that you need to identify what reversal patterns look like, not just where price is supposed to turn, because, well, we never know where things are supposed to turn, just where they could turn and where it's likely to turn. But even then, once it gets there, we still need to know what they look like when it does begin to turn. So that's step one, is having patterns. From there, having levels, and then having a plan. Higher time frames absolutely are a must, right? People ask me all the time, what time frame do you trade on? My trade chart, I never show you guys, right? I always show you my analysis chart, the 5 minute. and I don't just look at the five. I've got four screens, two computers, and I'm running both with one keyboard, one mouse. I'm hopping around all over the place analyzing different time frames because one time frame isn't good, right? It's not good enough. Anyways, I feel blind if I don't check up and down the line. And I start the day top down. I do it in the morning briefing. I show you guys daily, weekly, hourly, intraday, preparing for those levels and trying to identify what moving averages are over my head, what are underneath my feet. If we break out, if we break down, what are we going to hit? Then it leads us to the other topic for the day, which would be how to identify what kind of trading we should get today. Range day, trend day, sideways day. So, next piece would be these different days. Someone's asking about AXP. Let's jump over there and check that out. This is a good one. Now they didn't mention time frame, so we're just going to do it the way I would anything else. Although we have a nice intraday wedge forming and it's a rising wedge. So what we expect with rising wedges is that they'll break down. I used to have another little sticker. I can't find it. I think it's on a Discord where I let the nitro expire, but I had a nice little sticker that showed a beautiful wedge like this and how these kind of wedges break down. Although sometimes it will give a fake breakout first and then it'll dump. So if we're just talking about the intraday, that's the analysis. I can already spot that we have a reversal pattern forming and that we're looking for a downward move, maybe after a blow off top signal, but that would be the intraday. If we look out here on the daily, I've got an issue with cup and handles, right? Cup and handles in the textbook, they always talk about this equal matching high or equal matching low. And I disagree completely. I have found those to be a cup and handle while a double top extends through the line, right? If it matches perfectly, it is a really great example of a cup and handle, and we expect to go on. If it overshoots, however, I find that to be a great bull trap or bear trap, depending on what direction, and then we look to go the other way. So if we line up on American Express and we check high with the new high, we can see that we overshot. We didn't overshoot enough though, so there wasn't no bull trap. But if it had exceeded and it got up into, say, the 111, I would have been looking for a bull trap and I would try to run this thing back into like 250, 220. But it didn't get that high. So this is a cup and handle. Handle should give us 1/3. So if you know where the half is, you can kind of eyeball where a third is. And this is a cup and handle with a 1/3 handle on it. It should rise from here, right? And this is also in a smaller measure. There's your TRB setup. So your trend line breakover should start to form here. So define your time frame and then hone in from the bigger picture to the smaller picture. I'm on the weekly. So we've got a weekly cup and handle. We got a weekly TRB. We can also identify in the shorter term where our structure is and what we have to get through. So if we was going to do this TRB and run it back up, which could also form like a cup or a cup and handle, a flag, a bear flag, I mean, it could form any and all of those. It would still need to get through this 30, basically 301 for us to try to make that turn. If we can't make the turn, then we're going to go back down and likely going to continue to go lower. Do I keep going in and out? I do keep pausing, yeah. I can't talk and type at the same time, so I just stop. Yeah, someday we'll have, I don't know. I can't do it. I know that there's people who can talk and type. I do good to chew bubble gum and walk, you know. So from the weekly or monthly, I've even seen people do yearly and quarterly charts, which I don't know. I mean, a good rule of thumb is if you come across a chart and it's gappy and violent and ugly and you can't seem to find a pattern, go to a higher time frame. That is really helpful. So I've had to leave the daily and go to a weekly. I've had to leave a weekly and go to a monthly. I can't say that I've ever really had to leave a monthly and go to a quarterly or a yearly, but we could, right? And so I don't want to say don't do it. I just haven't really had an opportunity to need to. So you can start with the one that you can read. If the daily is giving you everything you need, do you really need a weekly? I mean, it's on you, but work your way down from there. We've got a reversal marked, the level that it has to get through if we're going to get a trade on for long, and that would be a confirmation trade. If we want to get a trade without confirmation, for me personally, I would need to tighten up the price that the weekly wouldn't do it for me. We'd have to go somewhere lower. And even while we're still here, we know that this level has been defended before. And we want to find any pattern or signal that says they are still trying to defend this level now. So that we can drop down now into a smaller time frame and look at what, say, the daily has to offer. We've got a really beautiful trend: lower highs, lower lows, consistent swings, and then this big, ugly gap, right? And gaps are not good. The problem with this gap, if we had gapped down from up here, I would be much more happy with a short, like this gap that we did have, right? Between those two candles, a fantastic gap. And the one before that was a really great gap, right? So we gapped here, that's not filled. And then we gapped here, and that one's not filled. and then we gapped here, and that one's not filled. And all of those are really great gaps. Look at the way that the red bar formed after it gapped down and it closed near the low of the day. Even on the attempted run back up with that little wick up here, they never got close to getting that gap closed, but they gave it a little bit of a shot. This one was even worse. And then this one, they didn't even try, right? We just opened and they dumped it like crazy. But they managed to run it back more than half, which is why, we started to get that bit of a reversal. On the move back up, we didn't even make it to 50%. And then down we went again. And we had a gap. We'll clean this up. We had a gap here, but they got that one closed. Then we gapped again. Really beautiful reversal pattern. I mean, you got to love that pattern. That's fantastic. And follow through the next day, closing near the highs. And they got this gap closed, almost like a liquidity gap. They got it closed, and that was it, right? We opened up the next day, gapped into that level, and we've been working our way down since then. So we came back down, and now we're where we are and trying to figure out on this time frame, what are we doing here? From what we can tell, one, we're still stuck inside of yesterday's range. We would want to resolve that. Two, we've got this broader range over just the last week. We would also need to resolve in this area here. So we got to get out of that box. And if you want a low risk entry, you would want to try to fill at the lowest area in this zone as possible. Here's a couple problems if I was looking for a trade. We haven't checked this low yet. And a lot of times, price is going to check that low. It'll be a really beautiful matching bottom, like the inverse cup that we were talking about, or it'll overshoot that bottom and get into like a 111, which would give us a nice, say, inverse cup and handle kind of thing, right? So double bottom or cup and handle, upside down cup and handle, either one of those would be great. We don't have either one. We never got there. And I don't like that unresolved low down here. Kind of makes me think they're still going to go get it. And maybe they don't, but that's my hang up right now is we didn't get to this low. We haven't checked it yet. We don't have new highs yet. So if we can break this high and start setting higher highs, or if we can go down and check that low, I would like this trade a lot more. Then you can add in things like your trend lines. We don't have a trend line breakover at all yet, nothing even remotely close. And if we wanted to measure the last leg, I don't think we even made it to the half yet, let alone through it. Yeah, there's the half. We haven't even been able to test the half yet. So we don't know if we can go long. We don't know if we should go short. We're not against resistance or support, and we're kind of hanging out in the middle of nowhere. Don't really have a good trade here, not on these time frames. So I'd have to shorten it up, or I'd have to go higher and be willing to take a different time frame trade other than what we have there. On the intraday, I think that lines us out really nice. That rising wedge right there. And that I'm on a 5, but that very likely is there on a 15 as well. Yeah, I mean, yeah, it's not as good, but it's there. So failed bear flag of yesterday, beautiful reversal right back to the half. Did exactly what it was supposed to. Short-term trade with a follow through into today that's leading us back up to the top. And so all we really have here at this point, right, is like a cup. And this says we're likely going to get that handle. Now, cup and handles generally resolve to the upside. So we could measure this whole thing and we could project 50% higher to the next level up as the next stopping point. I mean, if you was to sell a put here and you're comfortable owning the stock, yeah, this is a great place to do it because it resolves the issue of us not being on support, right? That way, It gives you time. You're not running like a hard stop that's just going to immediately trigger you out, which would be a bad idea. The soft put or the squishy put gives you a chance to sell a put, hang on to it, see if it recovers, and it should reverse. We just don't know if it's going to come down another 10 points yet or not, right? So the reversal, I'm not really hung up on it not reversing. I'm pretty comfortable with it reversing. Just is it going to come down another 10 points? Now, what you would want to be prepared for is what if I sell the put and it doesn't reverse and it wants to come back down and check this half? Are you willing to own it, at say 290 when it's sitting at 270? And of course, it's got decent options that you can sell. So say you end up with the stock and you have to sell calls against it for a while, you'd get your money back out of it eventually. But eventually could be a while, right? Like it could take you a couple months before you sell enough calls to make up your money on the differential and be able to get back out again. But it's American Express, right? It's not like Bobby's mowing service that's going to go out of business next week. So it'd be all right. Financials though are expected to have issues, right? That's why we took that XLF short. Um, Banks have been having it pretty good, but well, I don't know if there is a but because once we start cutting, I think banks are going to like that, right? Now, of course, when we do start cutting rates, it'll be because we've had a slowdown in jobs and the economy, and banks aren't going to like that. So you have to kind of weigh it between are the rate cuts that are coming because of the weakness that we're anticipating going to be enough to mess with the banks and financials or not? I don't know, but from a pattern standpoint, it's near support, and a short put would be not a bad idea. There are some additional tools that you can use, like order flow, um, level two, time and sales, but that's more of an intraday process. Certainly doesn't help, on the daily. A lot of old books will talk about volume, and I mean like just old school volume. And I remember when I was newer to trading, how many books really hammer down on the idea that volume is just so key, volume, 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 and how they would argue, oh, if you get a breakout and it doesn't have, like elevated volumes, then don't trade it. The breakout isn't going to work and blah, blah, blah. What a load of trash, and I got to the point where I just tried to find ways to not ever need generic volume because volume is so bland and misleading that it doesn't tell us anything. All this really tells us is how many trades took place. So I can look at it and say, whatever this number is, 5,632,000. But was it any good? So when I look at volume, there are things we can get out of it, right? I don't want to say it's completely worthless. Is the volume elevated versus its average? Did we have a crazy extreme spike? Was it wildly low? Low volume is always a really great signal, right? if it's just so tiny you got to zoom the chart in to even see the darn thing. But do I need, like wow volume? Investors Business Daily says that that's the kind of volume you want to see. Um, you want to see volume so big that you're like, dang, look at that. Like it's just so wow that you can't help but say, wow. You're not going to get that every time. And I think that's the books should just shut up about it because, there's better things than volume, or at least don't make it sound like it's the greatest thing since sliced bread because it's just one small piece of the puzzle. But you can bring volume into it, especially if you have a way to differentiate buy volume from sell volume. So at lows, for an example, a lot of times at the low, market lows, you'll see the greatest amount of volume. And a lot of times that bar closes red. And so it'll show red volume at the lows of a red chart. And the next day it's ripping to the moon, right? But if we was to go in and look at that one red day and that one red volume, and we looked at buy volume versus sell volume, we'd see a massive discrepancy. And that what happened is since that day closed red, by default, it made the volume red. But that didn't mean that all the volume that day was negative. So you have to kind of parse the information out a little bit when it comes to edges. And for intraday trading, we've got order flow. We can bring the tape in. And level 2 is see where they're looking to load up. And for companies like American Express, it's not isolated, right? It's not trading by itself. So you would want to look at its peer group. I believe this one's a part of the capital markets. Let me just check because I certainly don't know all of these guys by name, where their grouping is. Maybe it's not a capital market, huh? It's one of the others. Let's see, we want fundamentals. Well, that's a list. Alphabetize this thing. Yeah, that helps. Custom expression exceeded. But you'll want to look at its group, its peer group. We used to have a code on the Discord where you could just type in peers and then give it a name and it would tell you its peer group. So what that expression means is Thinkorswim is only going to allocate so much memory on their servers to show you something that you want to see. And with these watch list columns, every column is hitting the server and asking the server for information. If we give it a watch list with too many names, it'll say you have exceeded the amount of server memory that we're willing to donate to you. And so it'll just give you an error after that, which is why I make those watch lists that say blank, right? Because if you have a watch list that is showing a lot of names and you start getting that error, then I blank my watch lists except for the one list that I want to see. Then all is good. and it's got American Express as information technology, financials. That's not really helpful. Financials is not helpful at all. Let's try this another way. Go to heat map, S&P 100, open up the little drop down and go to financials, consumer finance. Boy, all that work to get here, but there you go. It'll take your watch list and separate it into sectors for you if you just go into the heat map. What a mess. So you would want to look at other financials of the same type, right? That way, you want to see, first of all, is the market that I want to trade acting like its peers? And if it's not, is it leading its peers or if it's lagging its peers? Because it might play catch up or they may play catch up. Then who's got the better options? Who's got the better chart and wins earnings, dividend, blah, blah, blah. So for consumer finance, looks like we got Capital One Services, American Express, and then these guys are in a different box, I believe. Let's see. Should be able to open that up. Yep. Consumer finance. Yeah, just those two. The other two are in a different box. Capital One does not have good options, but we can still look. Yeah, their chart don't look anything like it's much higher up, right? American Express is like down here along this level, and these guys are like near the halfback. So either American Express is leading or it's weak while its peer is strong. All right, so let's get into the type of days. Now, I have shared the book um, multiple times. You should be able to scroll up in the chat and see it. And I'm searching for it just in case. Secrets of a Pivot Boss. And in that book, it talked about these 6 types of days. Now, in reality, we all know that there's more than that, right? Because, yeah, I love that. I love that indicator. The problem with that indicator is it's a little much, right? Like it can be the most tangent connection with a peer and it'll do it, right? So secrets of a pivot boss, I've shared the pictures. I'm gonna bring them up here on mine of these 6 types of trading days. And I wanted you to notice that there's more than these 6, right? So this is one of the pictures that I shared. This is a sideways day. And in the book, they talk about the initial balance. And it's really important to focus on because in the pre-market, it's one of the main things that we do have, right? We don't have a lot of information in the pre-market. So we do have initial balance. If there was an initial balance range, and then we are still in our Globex range, and we're still going sideways within the range that was made by the initial balance, then we want to classify that as a sideways day. One of the key characteristics of a sideways day as opposed to a range day, because those are two completely different things, is that with a sideways day, a lot of times the reversals don't reach the edges. You just get random reversals in the middle of nowhere. And when you do get to the edges, a lot of times it jacks around there for a while before it tries to leave, rather than having good, clean rejections off of the edges. And you usually get a lot of muddy price action in the middle where it's just not doing much of anything. False breakouts and wick rises and swift drops and just nothing good. Now, sideways days are awesome if you want to trade options. They're usually narrow. You can put like 0-day iron condors on, could play the edges with credit spreads. They're fantastic for short sellers, but that's about all they're good for, right? Except when you get a narrow range day, it starts to set us up for a potential squeeze in the next 2 or 3 days, So I kind of get happy when we see sideways days, only because I'm thinking ahead about what we could get later in the week. On that sideways day itself, kind of like, eh, I don't really interested. Now, a trading range day, on the other hand, while it may at first glance look like a sideways day, there's some differences. It has a wide initial balance, and then we are tagging and bouncing off of that initial balance high and low. And we are looking for very clean reversal patterns off of those levels. We don't want to see price get there and jack around and fake drops and run back up and all that silly kind of stuff. We just want nice, solid candle pattern reversals. And range days can offer some of the best trading opportunities for every kind of trader. Swing traders, day traders, uh, you know, premium sellers, buy options. They're fantastic. And you'll find people who say, "I love trading range days." And those are the same guys that say, "I hate trading trend because I don't know where it's going and I don't know when it's going to stop." There's no wrong to it, right? Now, expanded typical. The range from initial balance is kind of moderate. It's not really big, it's not really small. And we hold that range until eventually it breaks. Now, they show that as a downside move, which is why I say, there could be more than six, but we want to focus on it as the type of day. This can look the same way, even if we flipped it over. It would have a moderate initial balance, and it would bounce between the initial balance high and low, and then it would eventually break to the upside rather than the downside. But it would still be an expanded typical day, which is what this did. This is a typical day. Wide initial balance, tagging the high, tagging the low, really not getting much done other than that, and just kind of maintaining the day. Right? So if we jump back one, we had just your regular everyday typical day, and then we expanded and ended the day off of it, either to the lows or to the highs. Double distribution, narrow balance. We ping pong in between that narrow balance high and low. Then we get the breakout, and then we redistribute up here and spend the rest of the day doing that. You can look for these signs, right? It says initiative buying, aggressive buying, participation, new buyers, depending on, if you're using like options or something, new positions being traded, uh, increased. We won't know that it's say open interest until tomorrow, but increases of volumes greater than the open interest would tell us that it was new positions. Anything that we can spot for like new buyers rather than people trying to sell against that level, and then the new distribution across the top. So if you haven't caught on yet, for every one of these, it has an initial balance as the projection. So in the pre market, when I'm doing my morning briefing, while I don't sit there and point out, hey, there's the initial balance, I go through the work of talking about what we have at this point, where we've been, what our current range is, and what we need to have if we're going to break out. Just like I did this morning, like I do every morning, I focus on that as a key aspect of what I'm looking for to trade today. Are we even supposed to break out? It's one of the questions that I try to answer every morning. Because if we're not supposed to break out, then I'm going to try to short it at the edge. Sure, you would want to buy at support, right? If you can, of course. But you don't always get that chance, right? Where's that double distribution? I think I passed it already. So these initiative buyers, this narrow range happened between 6 and 7 p.m. Then we had the overnight, and a lot of those trading firms, they won't trade in the overnight. They are only going to trade between 9:30 and 4. So they didn't get a chance to buy down here. They weren't at work. Or you and me, for an example. When the day is done, I'm out. I don't come back in this office and I don't trade into the evening anymore. So while it was tagging these lows at 2 o'clock in the morning, I was sleeping. I didn't get a chance to buy that low. But yeah, it would be better to buy support than buy the breakout. Unfortunately, we just don't always get a chance to buy that support level. Yeah. Yeah, that was me. Those 6 million contracts traded in the Asian session. It's all gone. I I don't I don't know. I miss it, but I don't miss it because I've put a lot of work in to have evening trade setups, evening strategies. But that's all gone, because I just never come in and do that. So the initiative buying comment here, it's not saying that we should be buying, right? That's not what this is telling us. It's telling us that we want to look to see if there is new buying on that breakout. Not that we need to be the buyers on that breakout. And the same thing here with the initiative selling. We don't need to be the sellers. We just want to see if there is new sellers. Every single day, inevitably, I almost always see a comment where somebody says, "Oh man, what a day." And I'm not talking about like every day. I mean on all these sideways days. There's almost somebody who says on a sideways day, "I wish I'd have known it was going to be a sideways day because I got my butt handed to me and I wouldn't have even bothered trading if I'd have known it was going to be a day like this." And of course, that hurts because we're doing our best to help you try to spot these kind of days and warn you in advance that hey, it's probably going to be trash today. You might want to just leave it alone. Go golf or something and do something else. But if you haven't come across it yet, one of the first things that you want to focus on, and I'll just use the 9:30 open here. At 9:30, look left and ask a very basic question. Are we still inside of our own Globex range? The Globex range is what I just highlighted, right? It's everything that happened in the overnight hours from where we closed the day before at 4 o'clock. So we can see as we got into the open, yes, we are inside of our own Globex range. Well, until we leave that range, you need to have every expectation that we're just going to sit there and bebop around inside that thing. We have no clue that we're going to get out of it or not if this is the only thing that we have, which it's not, right? We have more than this. But if that's all you got, then that's your answer. Don't expect anything more than this range until you actually get more than this range. And look, we tested that high. We were never able to keep it because that high wasn't as high as yesterday's high. And we never managed to get an inside day breakout here. We stayed completely inside the previous day's range. We spent most of the day inside of our own range. So we can add more to this than that. But if that was all you had, then you could have had a really good expectation that today would have been trash simply because when you looked left, that's all you had. Look at the narrow range that we had in the entire night. Nothing. Now, was it people look at this and they hear me say that and then they say, so I shouldn't have traded it? Well, I'm not saying that. Everybody can trade anything they want, right? I know of people who will trade stuff that I would never trade. And yet I trade things that people would say, oh, heck no, I wouldn't trade that. You have to have your own stomach for risk. And I really like this trade here. And I really like the reversals because these would have been 111s. And I like those, except that this one's too late in the day and I wouldn't have traded it. But I probably would have traded that one. Right. So, because I see the setup, it's my setup. It's mine right there. Mine. So I'm not telling you don't trade it, but I am saying this is what you should expect because that's what we had. So the first thing you want to do in the morning is look left and ask, hey, where's that Globex range and where are we? If we're still inside that range, then we have to get outside of that before we do anything else. And I say it every day in the morning briefing, GTFO. Get the beep out of that box, right? Get out of the box. And the box can be the Globex box, it could be yesterday's box, it can be the box on the week, and we can just keep drawing bigger and bigger and bigger boxes, just like we did this morning, right? Bring it into something a little more relevant. It was a real simple morning with a really nice setup. That's our Globex range. We'll just knock that one forward and that one backwards. There we go. That was our Globex range. All we had to do is get out of that box, which we did relatively fast, right? Before 10 a.m., we had the breakout and we were on the run. And what's the phrase? If we haven't broke out by 10 a.m., we ain't gonna. Okay, but if we do break out before 10 a.m., take it. I bought SPX call vertical when we did this breakout. It did not pay me for nothing. I'm trying not to swear because it messes with our algorithm. It sucked. That thing paid me nothing. Why? Because I bought the calls while we were already on the run. And what have I said about that? It sucks. You don't get really any money at all. I mean, I made money, don't get me wrong, but not what I should have made. If I could have bought those calls when we were still red, then I mean, they'd have probably paid something, but they didn't pay very well because we were green already, but I wanted it anyway, so I did it and I made a little bit of money, but sucked. Should have just traded it in the futures, but it looked like we were going to get to 4,000 in that first run this morning. So I'm like, well, if we're going to go to 6,400, that's what I meant, 6,400. If we're going to go there, then I'll run a call up. We didn't get there. Nice. That's nice though. The So another tip on these, and it fits with what Marziti was just talking about. If you do have something like Spot Gamma, its gamma readings were saying that this was so crazy bullish this morning that you would have been more comfortable putting on that put credit spread and knowing that unless we had something really negative hit, that you would have been okay. Because there was massive order flow in the options supporting 6400. We had Google running, Tesla running, and they were dragging the market higher. And they were coming in behind this and buying massive amounts of calls, showing that they were defending it like crazy. Now, that didn't get us to 6,400, right? That wouldn't have helped my trade, but it would have probably given you a little more confidence in your short put because they were really defending the downside to it. Back here at like 10, in that blue run, Spot Gamma really had a lot to show in that new trace system that they run. But it's a complicated system and it is not cheap, right? And you have to learn how to use it. And, I know experienced traders with it for over a year still say, yeah, man, it's confusing. But they've got all kinds of videos and resources and, like live events that you can, join in with. This is Spot Gamma, and this is the trace that we were just talking about. So as you can imagine, it's hard to read, right? It's complicated. And so, Hugo, on American Express, I am more than happy to lay out some levels or offer a trade opportunity. What what's your bias? You thinking it's going to hold up and maybe do well into the end of the year, or at least not break down into the end of the year? Because I do see that, right? I think that the halfback is really going to hold, and that unless we start losing a lot of financials, that this should either catch support around that 290 or at worst test that 275 halfback. But I really don't see this going into the dirt. You know what I mean? Like I don't see banks in general going into the dirt. Um, there's some warnings. There are some warnings, but they're not any worse now than they have been for 3 months. And what have we done in 3 months? You know what I mean? We just run and run, run, even with all those warnings. So I think uh, a call calendar maybe, or y- um, short put vertical. And if you want to try for something that's less risk, then do some like butterflies, because you can always add to the butterflies, right? You can add verticals to the legs of the butterfly to make it like a ratio to fly along the way. Butterflies are cheap, cheap. You could put on like a $300 butterfly and then, maybe like a 320 butterfly, trying to capture that test if we happen to run back up again and stall out. If we do get this TRB, have a butterfly sitting up there. They're so cheap, and especially if you get them out of the money and kick them down the road a little ways, you can add to them, break them apart, keep the risk light, and you can scatter them all over time, right? So 300 is kind of close since these are, ooh, those are rough. That's rough. It's a $10 wide strike price. Doesn't give you a lot of room. And now that I see that, I'm not so excited about it. But the bid ask spread ain't that bad considering it's $10 wide strikes. Um, yeah, that's rough. Well, I don't know. Let's see. I bet it ain't gonna price well. $1.80. Know what you can do with that $1.80. That's it too. That's the next one out. So I don't like it as much now. They are cheap though. If you want to go, even farther out, find something a little more reasonable. There's a $32 butterfly. So you stack that on, and then if it stalls out, add a call credit spread on these levels. And if it doesn't stack out at 300 and it tries to break out and continue to run, then stack put a call debit spread on top of these, right? And that way you've already got one, you're just adding to it. Butterflies are always a good way to go if you want to dabble, but you want to keep your risk light. They're cheaper than verticals, in my opinion, um, and offer more opportunities. But keep your eye on its peers and keep your eye on the 10-2 yield curve, along with, of course, interest rates. But we're all watching interest rates, right? It's not like telling someone to watch interest rates is like telling them to watch Google. I mean, I think we're all looking at Google, Amazon, Microsoft, Meta, Tesla. I don't think I need to remind anybody to look at those. So come in the morning. First thing you do, look left. Mark out the Globex range. And after reading that book, hopefully you're going to start to mark out the initial balance. There's been some considerations about the initial balance over the years, and it's the fact that we live in a global marketplace. So for all of us, there's the 6 o'clock open, and that's the initial balance that the author was referring to. But then you've got traders that come in the Asian session, and they will mark out their quote open range. They call it their initial balance. Whatever. It's a 1 hour open range from Asia's open. Then you've got Europe's open and their 1 hour open range. And then you've got the 9:30 open with that 1 hour range. Every one of those has a true close. So you run, the 1 hour high and the 1 hour low and the 1 hour close for 6 to 7, and then the Asian session, then the European session, and then our session. And that's more levels. But what the book is talking about with initial balance is 6 to 7. So here's 6 o'clock, right? Right there, 6 o'clock low, and 7 o'clock. This would be the high, even though it's not 7 o'clock. That's as high as we got between 6 and 7. And that would be our initial balance. If you're on TradingView, the true close indicator should already be marking for you the Asian, European, and US time frames. I thought I had it up here. I guess I don't. Do 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 do. Feel like this is the point where we need, like, the elevator music playing. Dun, 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 dun. Yeah, and put it on a normal market that we all understand, and then check to make sure that we're shaded correctly. We are. So there's London, Asian, and it's got Australian, but that's just a joke, anyways. And of course, that's also the initial balance. So there's the initial balance. You mark out that initial balance, and that gives you a range within your Globex range. And it is the topic of every one of those pictures is what's our initial balance. Now, before I had ever read that book, the indicator that I just turned on is called True Close. True Close. And if you're going to turn that on, what I recommend is scrolling over to the dots and reading his little write up. Read this about the script piece here. He did a good job. I kind of disagree with some of the stuff he said, but nothing out of line. And he's not in our country. He coded this from his nation, so he used a time frame for these that when I went in to adjust things, it didn't work out. So I would say don't mess with it. The only thing I do now is I get rid of the heavy shading because I don't like it this dark, and I get rid of this box up here because I don't like having that on my chart. You can't gray out these boxes, like by using the slider. That doesn't work. So what I did is I just chose a darker color, and that did work. That solved the problem, right? So if you go in and you want to make them not so vibrant, don't use the slider. Just pick a different color, and then of course you can turn that box off too. Table, not box. There we go. Turn the table off. It is really interesting. It does the work for you, which is what I like, right? So that'll give you your initial balance. Now, if you did want just the initial balance, if you didn't want, like the Asian and the London and the US market and all the other stuff that comes with it, you can just search initial balance because I'm fairly positive that somebody's already made initial balance indicators that are just for 6 to 7. And then you'll be good to go there too. So you fire it up, get into the charts, mark out yesterday's or last night's Globex, and then look left at where we're at as we get into the open. Now, I wanted to talk today about something that it wasn't on the topic discussion, but from a day trader's perspective, it's something that I'm I've got quite of a bit of opinion on, and I think it's a useful insight. Just keep in mind if you do what I say I'm about to tell you that I don't do, I'm not telling you that you're wrong and that I'm right. This isn't about right and wrong. This is just how I trade and how I see things and what I won't do because I've learned better. Between 9:30 and 10 o'clock, I almost never trade. Seriously, I don't even bother trying to trade. I don't look for trades. I don't look for setups. Most of the time, I don't even have my trading broker up during that time. I have my analysis platform up, but I'm not even attempting to take a trade here. Why? Because I don't care. I am not trying to get this run. Now, what I found from most new traders is that they say, wow, the open has the biggest moves statistically in the whole day, unless you count the kill zone, which they don't even know about. So we'll leave the kill zone out of this and we'll just focus on the big move at the open. New traders see this big move at the open and they say, oh my gosh, I want to learn to trade that big move at the open. I want to trade the open. I want to catch these big moves. If I can just trade that 1 hour of the day, then I could spend the rest of the day doing anything else and I'm going to be a big baller. Well, there's a couple of problems with that. One is the market at the open is very violent. So you have to use a bigger stop or you have to be really good at reading order flow. And no other tool is going to help you, right? Like RSIs, MACDs, stochastics, none of that stuff is going to work. None of it. So, usually we put a little asterisk there and we say, sure, if you like it, use it. I'm telling you, it ain't going to work. So, no indicator of legacy style with the MACDs and stochastics and none of that stuff. Trash it. VWAP, throw it away. Point of control, throw it away. None of it is going to work in that first hour, especially the first 30 minutes. Focus on that and that big run. The candles are really violent. It's whipping up and down like crazy, and you have to use a broader stop just to avoid getting wicked out to be able to even stay in the trade to try to sustain the move. And what are people actually looking for? Well, they want a lot of points on the day. I get it. I want a lot of points on the day too. The thing is, we can get points from two different things. I can take one or two contracts and I can hold on for a 20-point move. And if I had one contract, I made 20 points. Woohoo! I can take five contracts and hold for a 3-point move, and I've got 15 points, just like that. Boom. Now, what's more likely? That I can find a 5 to 8 point move 15 to 20 times today? Probably. Or that I'm going to find a 20-point move that I can trade today, preferably at the open, which is what they're all trying to do, right? So if you're trying to make money on the day and you want to get a lot of points, I get it, just like anybody else. Don't try to get those points in the most violent market imaginable at first thing in the open when you're trying to run this, especially with a small account using small stops, because that's like the worst thing that you can do. It's also the hardest thing that you can do. Instead, focus on repeatable, observable patterns and signals that you can trade in a less violent time of the day. And then get good enough at those that you can size up into 3, 5, 15, 35 contracts, and you can trade a 5-point move with 40 contracts and be done for the day. And you didn't need to use really wide stops and try to play in a violent market where reversals are known to be the most prominent, right? The rug reversals at the open, the fake outs and just the beat downs that come with it. Can you make a lot of money? Yeah, of course. Most of the people that I know that trade the open, they don't trade with size. Why? Because it was too damn violent. They're trading one or two contracts and they're trying to run it the whole way. Get 60 points, 40 points in the whole move. I get it. I can get 40 points in a 5-point move with a lot less risk and a lot less violence and a lot more consistency and repeatability and scalability. So I just don't do it. The phrase that I've heard from people though is, well, experienced traders trade it. Yeah, and you're right. Experienced traders do. Most of the experienced traders that I've come across, though, when when you get the experience, you realize you don't want to trade it. Can I trade the open? Yes, I can. I can trade the open, no problem. Do I want to? Heck no. Why? Because my experience tells me that's a really bad idea. I have done a 30. When I'm doing analysis, I use a 1 hour. So I have a 5-minute open range that I do analysis with, and then I have a 1 hour that I do analysis with. I don't mind putting a 30 on just to look around, but I almost never use a 30 for analysis anymore. There's nothing wrong with it. Don't get me wrong. When I first heard about open ranges, it was in a book, old book, and they had delayed data back then, and they only used a 1 hour. So I used that because it was the only thing I'd ever come across. And after well, a couple months, I realized, man, the 1 hour is just it's way too late in the game. I need something sooner. So I did a 30 minute, and then I did a 15 minute, and then I did a 5 minute, and I really like the five. It has a lot of information in there for analysis. And then I really like the 1 hour because I rarely trade before 9:30 and 10:30. Right. In that window, I rarely ever trade. So the 1 hour suits me and it matches for the analysis perfectly. For the question on the SPX, the I'm an options trader, right? And options trading is a really big part of what I like to do. When it comes to trying to trade the SPX, the first 15 minutes, the options flow is just trash, right? Like you can't even read it. It's a fire hose of orders coming in nonstop. And that's getting better because of the whole 24-hour trading in the SPX. So it is getting better. But for most of my career, it sucked. And the order flow and the options in the SPX didn't even start to get clean until around like 10 o'clock. So if you tried to get into the SPX and options before 10, say like a year ago, 2 years ago, you were fighting really wide spreads and you'd have to chase the order like crazy to get filled or just market order in and get hammered in the head, right? And it sucked. So I didn't like to trade in that window anyways in the SPX just because the order flow and the options was so horrible, which it is getting better. But at the same time, there's a lot of white papers, college research, broker institution research that talks about that first 30-minute fake out play, right? Or at the bare minimum, it's not a play, that it's just an idea that you should wait 30 minutes to give price a fair chance so that you have a better idea of where the hell do you think we're going to go today, right? So if you wait for at least the first 30 minutes, you'll get better order flow in the options. You'll have a much better idea of what the market has in store for you today. And then you can make a more informed decision about what options you want to trade. And if you go back in the past and apply something like a open range indicator, I've got one, right? Like I've got a number of them. One that shows you the previous day's range, and you can just scroll back and see what price was doing after that first 30 minutes. Then you can kind of develop a game plan for what do you want to do, right? Mechanical trading, I'm a big fan of it. I've covered it extensively. But when it comes to 0-day trading or intraday options trading, I'm not a big fan of putting a trade on every single day just because we can, right? Like, especially premium sellers coming in and putting on a call credit spread on a 0-day every single day just because we can. It's a bad idea. And I've proven it to be so over and over again that we want to be selective about those days to choose when we put on a 0-day and when we don't put on a 0-day. Um, ORB, I've got multiples here. We'll just put on this one and I'll move this box out of the way. It is by default a 1 hour, but you can change it in the language. And then the yellow line here is the true close. All right. So that's one. And if I open it, it gives me a chance to change when I want it to mark. It will sound an alert and it'll put an alert up at the top if we break that range. And then it asks, what kind of noise do you want? You can change the colors and turn off the cloud, I believe, and then you can mess around with the labels down here or the alert noises. So that's one type. But if you notice, it didn't show yesterday. And I don't think I left it in there to give you a chance to show yesterday. A lot of these will ask, do you want today only or do you want to see previous days? This does not show you previous days. So this one wouldn't be good for what we were just talking about. So let's look at the other one. And I've got more in the Thinkorswim workbook. So if this other one also doesn't look back, then we'll jump over to the Thinkorswim workbook. Yeah, it also doesn't look back. This one's adding measured fib levels or quadrant levels. They called them fibs. I call them quadrants. But it just measured the open range and it laid out quadrants from that. And I like that. That's why it's still in my Thinkorswim because I clean mine out. But for that, I use that's what I use the 5 minute for. That 935 bar, that 5 minute bar is excellent for marking out quadrant levels. If it's a big bar, if it's a small bar, it doesn't offer any insight, right? But if you get that first 5 minute bar and it's a really big bar, I love that bar. Well, I run in so excited and I mark it out and draw the extrapolated levels from it because I just get so excited about it. But this today is a little bitty one. Yesterday's was better. Look how we maintained that 5-minute bar until 10 o'clock when we broke down. Love it. 5-minute analysis, right? You can do 1-minute analysis, and funny enough, you can just turn time off completely and you can use tick charts with swing high, swing low analysis. I love that too. So I did not have the open range study that shows multiple days. I was hoping I did, but I don't. But I do have it in the Thinkorswim workbook. So we'd want to go there and dig it out of the workbook. All right. All of these indicators within this channel focus on open range. So there's your basics, a cloud version, 30-minute with fibs, TPO built into it, like a volume profile, fib extensions, multiple open ranges. I've got all kinds, right? All kinds. Scanners, if you want to put it in the watch list. And then this one is for if you're using a tick chart the way I do, and you just want swing high, swing low rather than first five high and first five low. I built probably half of these. I bet I didn't build all of them. Different versions. Um, one might have labels, one might not. You know what I mean? One may be fixed where you can't change the time, another one not. Yeah, there's no right or wrong. And what I usually tell people is start at the top of the list. Oh, all of them. These are all open range. Every single one. Open range, open range, open range, open range, open range, range. Start with the one at the top. Try it. If you don't like that one, try another one. If you don't like that one, try another one. I haven't made a post in here since August of 2021. Trust me when I tell you, I do not remember which one of these shows previous days. I have no idea. None. You'll have to just hunt around and find the one that shows previous days because I do not know. And then one channel up is the whole background behind why the open range. Why do we even use it? Why does it work? Including a nice little trade setup document. Like I said, I've done a lot of work on this because it was one of the key questions I was trying to answer to become a day trader is what kind of day are we going to have? Right? It's kind of a big deal. This entire Discord, for an example, is nothing but research on the kind of days that we have. Because until I had that book, I was doing all the work on my own, right? And I didn't have the book. So I was coming up with my own system, my own style, and I thought I was doing pretty good. But it helped to have the book because he articulated that initial balance that I never added to my system. So it definitely brought that in. And then finally, in 2024, I come across that book. Ain't that cute? I got so many little sticker programs. It's nice to use them. So I am particular about what I consider a trend day and what I don't consider a trend day. Leave the book aside for a minute and let's just kind of focus on this because I get this question a lot. And it's one of the key things that I address in my own coaching group is what a trend day is. Being able to recognize, and we're talking about intraday, what's a trend, right? Is like new traders just get stuck on this. What's a trend? If I zoom back here and I point out that red right there, is that trend? Yeah, we could call it one time framing, a sell off, an impulse. It's a lot of things. Is this a trend day? This one. And and on trend days, don't we have very specific qualifications on how we can trade trend days? Trend days have tradable opportunity, right? So we know what our trend trade strategies are. If we called this a trend day, we would employ those trend day tactics. So what would we be looking for? 786 pullbacks, 123 breakouts to the next level lower, really nice clean price action, defining a trend and giving us actionable tradable opportunity all the way down. I don't know about you, but I don't see that. I can zoom in. This time frame doesn't have it, right? So as I said, I'm picky, right? Um, Before I came across that book, some of the rules that I had for a trend day is really basic because simple works. If I looked left and we were inside of yesterday's price action, or we're going back inside because we had broke out, then it's not a trend day. Here's yesterday's price action, and let's get rid of these other candles because in the stream, it may be a little difficult to focus on what we're saying here. So we opened and we are inside of yesterday's price. And as far as I'm concerned, if I'm inside of yesterday's price, this, no matter how beautiful it looks, cannot be a trend day. It can't be a trend day because we're inside of yesterday's price action. We are in a range. Can we have trendable, tradable price in a range? Yep. But we would just be trading range day tactics. We would be in a ranged market because we are inside of yesterday's price action. By the very definition of it, as far as I was concerned, before I got a hold of that book, right, that there is no way this would be a trend day because it's inside of yesterday's price action. And I can make that statement even more clearly if we were still inside of Globex price action. You get one of those days where you get a really big Globex and then we fall and we spend the rest of the day moving inside that. And it might be really pretty, but it's not a trend day. And I wouldn't employ trend day tactics because we're not outside of the previous day's range. Heck, we're not even outside of our own Globex range. And you'd be surprised at how well that sharpened what I was looking for because I wasn't hung up on should I be doing trend day tactics? I mean, it looks like we're trending. Are we trending? What's trend? We're inside of yesterday's price action. That ain't trend. It cannot be trend. Doesn't mean I can't trade it, right? But we all do that, and that's where the breakdown came in for me, at least. When I was trying to grow into a day trader, I got stuck on this concept, right? It looks like it's trending. Can't I trade it as a trend? Not on this time frame, right? We all know that yes, this was a pullback. If I went to a 1 minute or a small tick chart, I would have really nice pullbacks and another breakdown and another pullback and another breakdown. Absolutely true, 100%, but not here. And not for my analysis. Because if I'm going to define this as, well, when is the trend going to end? I don't know. It's not fitting the quadrant levels. It's not stopping where it should. It's not pulling back where it should. And it's not legging down to the next level the way it should. This is impulse. This is one time framing. This is single market direction. This is falling out of bed, whatever language you want to use. Same thing back here. Is it tradable? Yeah, I mean, absolutely. It's single bar price action, but I wouldn't trade it as a trend. So in that Discord, I spent a lot of time building out the definitions of, well, what is a trend day and what kind of trend days do we have? We got those trend days that run until lunch and stop. We have the trend days that run until lunch and then reverse and give it all back. And we have the trend days that run until lunch, get through lunch, and then continue to run for the rest of the day in the same direction. So three different kinds of trend days. Oh, the fourth one, where we don't trend until lunch, but once we get through lunch, we actually start trending. So range into lunch and then trend for the afternoon session. We can do all of those. But if we are to do any of them, we would first need to meet the qualification that we are no longer in our Globex and that we are no longer inside of yesterday's price action. Because if we are, then it's not trend day. That made it a lot easier to help me try to spot, can today be a trend day? And if so, what do I need it to do before it could be a trend day? If I look left and yesterday's day is this big and we open damn near perfectly in the middle and somebody says, "Can we trend today?" Yeah, but we're going to need to run all the way up and break the outside and then begin to trend. And that's a tall order to ask on a Friday afternoon. Or we're going to need to break all the way down and get below that and then have a trend day. And that's a tall order to ask on a Friday afternoon. And so it really was my cheat sheet way of trying to solve this problem before I had the whole initial balance stuff added to it. Right. Because I just didn't have that. I was trying to find a solution. My solution worked. Unfortunately, it also missed opportunities to trade, when we had really good price, but we were still inside yesterday's price action. Because, I mean, you can have both, right? Yeah, but I try to make the distinction because we need to leave first one range and then leave the other range. So it's best if you first define what's your Globex range and then what's your yesterday range. And if you need to, there would actually be three. What's your Globex range? What's your RTH range of yesterday? And then what's your all of yesterday range? My solution was, if we were not outside of the previous day's price action, today cannot be a trend day until we get outside. And the reason that worked so well is because when you do get an inside day breakout in the indexes and it sticks, it goes, right? And when it don't, it's a beautiful reversal and you come right back in again. So as long as we're inside of yesterday's price, like we are today, we cannot have a trend day till we get out of the box, right? Today's box would be the Globex and then the RTH of yesterday and then all of yesterday. And if we can manage to get out of all of that, then we could have a trend day. You could run the iron condor on that logic, but what you would want to do is try to answer, are we supposed to stay sideways? In the morning briefing, one of the questions that I bring up every day is, what's happening right now and what's on the docket today, right? Are we low volume in the overnight? Are we getting a lot of volume? What kind of news? What kind of economic events are on the table? And is there any behavior that makes me believe we're going to break out or break down today? Because I don't care how it looks like we're going to break out. If if I think today's supposed to be range and we try to break out, I'm going to short that sucker. I don't care how good it looks. I will try to short it because we're not supposed to break out today. On the other hand, if we're supposed to have big news and that it's possible for us to break out today for whatever reason, then I'm less hesitant to say, well, let's play the range. The thing is, a lot of times we know, right? What do we know about next week, for an example? And I brought this up in the morning briefing. Next week is OPEX, and it's very likely to remove our guardrails, the bumper cars that's been holding us in place. Without it, we could really finally get out of this range and run. And my caveat to that was if we actually hold the breakout today and get somewhere. Because if we do that, then the range is already broken. It won't matter if the guardrails are still there next week. We already broke them. Here's next week's range. That is the projected weekly expected move for next week. And one of my tells for what kind of trading week are we going to have, and therefore what kind of trading day are we going to have, is what's expected from next week's trading. Look at the week that we just had and how wide the expectation was for the week. They thought we could go at least this far this week, and they weren't wrong. We got there yesterday, and we're still pushing against it today. But look at next week. They think that next week's going to be very narrow. That's a little bit of a catch 22 and a trick. The market is showing that the options being traded support the idea of a market going sideways for at least half the week next week. Very likely because there's some big economic data on the table for next week. But at the bare minimum, there's also OPEX. And the closer we get to OPEX next week, the less likely it is that we're going to continue to move. So if we take a sneak peek into next week, got some auctions, CPI next week. That'd be a big one. Yeah, we got CPI, budget, jobs. That's the big one next week. PPI, CPI, and jobs. Retail sales. But it's in retail. The big one's jobs. And then, of course, OPEX. So, knowing that and seeing the narrow range for next week, the base case argument is that next week we really are likely to have a lot of these sideways days like we had back here. Days where we spent most of the day inside the previous day, and or that we get these sort of breakouts, these fake breakouts where we run back in, like this one where we broke out and we ran back in, and that we just go sideways for at least half the week until we get into that event. And that's what they're pricing in here is that, hey, next week we're likely to have a lot of narrow range days or a lack of follow through. So I'm more willing to do an iron condor next week on those sideways days because of this, right? And it's not just like the default of, I don't think we're going to break out. It's a big range yesterday, so let's just run an iron condor, which we can still do, right? It's just that this would give me more confidence to do it as opposed to we're getting really big breakout days and I don't want to get run over. So I try to treat every day as an individual day to do those 0 day plays. And for the SPX, for an example, I try to time those reversals on the day. Now, you get days like Thursday where we just kept going and going. And I'm sure you guys saw it. I tried to reverse this, right? Like at least twice yesterday, I tried to run it to the upside. It was having none of that, right? It just kept going and going and going and going all the way to power hour before it finally turned around. Most of the time, it's not like that, right? Most of the time, we get a reversal and we can time those pretty good. Just scroll back in the chat, you'll see it. I post, the reversal. I call it out, tell you where the OCC is. We're getting pretty good at those. But on the days that it don't turn, shoot, just keeps going, right? And if you'd have tried running your iron condors or verticals on those days, you'd have just got beat. You would have wanted to get just a straight out of the money option somewhere, buy a call, buy a put. In this case, buy a put far out of the money and just let it ride all day long. But you can't do that every day. I mean, technically you can. The institutions do, but you'll your win rate is really, really low, and the wins that you get definitely cover the losses. But I mean, you got to run it like every day, right? If you're going to do it that way, and I'm not a fan of it, just because it's hard to lose, you know, 37 times before you get your winner. Knowing that the winner is going to pay for the losers doesn't matter. You still got to lose 37 times, and that sucks. You gotta have a certain kind of fortitude to take 37 losses in a row and still put on trade number 38. The afternoon 0-day plays, in my opinion, are the better play, which means it suits my style because one, I'm not trying to trade between 9:30 and 10:30. Two, 10:30 is too close to lunch, so you might as well wait. Get into lunch and start focusing on what is the afternoon. Because while there's six type of trend days, there's three parts. I said that wrong. While there's six types of trading days, there's three parts to the day, right? And I'm talking about between 9:30 and 4. If we count all night, then there's six parts of the trading day. But between 9:30 and 4, you got three parts. You got the morning session, then you got lunch, and then you got the afternoon. So with that in mind, it suits me really well to focus on afternoon 0-day plays, especially on a premium trader's side. If you're buying, sure, play the morning. Get some cheap out of the money lotto somewhere, buy a call, buy a put. But if I'm going to sell options on a 0-day, I would much rather do it after, say, 1 o'clock in the afternoon. You got a much better hit rate. You have way more information. And a lot of times it's already given you all the information that you need. Like we've run a long ways and we've reversed, right? Like that kind of information. I made this a long time ago. I mean, a long time ago, but I still think it's relevant. Now, this shows, multiple pieces because I broke the afternoon down into power hour, right? But afternoon is still afternoon. It's one session. So you've got the open range, then you've got lunch, then you've got the afternoon. One, two, three, three pieces. And I don't want to do an afternoon trade while we're still in lunch. So 1 o'clock is kind of a good spot. And then for the things that I sell, I really don't like those way out of the money options. I just if I'm selling, right, not buying. If I'm going to put on a credit spread on a 0-day or an iron condor, I'd rather leg into the iron condor and I'd rather just put a spread on at the money or near the money. And that's hard to do when you don't know where the low is yet, right? When we're still falling and you're like, is that the low? Nope, we're still falling. Is that the low? I don't know. And then boom. Oh, well, shoot. Now it's too late. I didn't get a chance to get in at the low. So when it comes back and gives you another chance, I mean, that's awesome. But then you got to have the gusto to put it on. And I would use at the money as much as I can, near the money, at the money. That's what I want to put on. You'll get the most amount of credit and you have the least amount of risk. If you look at an options trade, talking about, selling to open, and obviously the market's closed, so, we're just going to use what we have. If I build a credit spread and I'm $5 wide and I did it at the money, they're going to give me 310 for it. Now, if I'm wrong, I'm risking, put it back at 310. I'm risking 190 here to make 310. First of all, we know I'm not going to get the full 310, right? We're not going for max profit. Most of us go for like 50% or 40%, 60%, somewhere around in there. So call it half. I can get $1.55. So I'm risking 190 for a chance to make 155. Well, not really, because if it's a loser, I don't need to hold it all the way into the close and take a full loss. So let's say risk 60% or maybe 70% of the full 190. Well, if we use simple math, say I'm risking $2, 50% of that is $1. So now I'm risking $1 for a chance to make 150. But that's not bad odds for a credit spread where usually people are risking 4 to make 1. I'm risking 1 to make 1.5. Sounds pretty good because I still have all of the added benefits that premium sellers have: the high win rate, the high expectation of profit, right? I got all of that still. So they are the ones that are handicapped, not me. And if I don't like this for whatever reason and I want to edge it a little bit, then I'll just step slightly out of the money. This suits my trading style. What I don't want to do is try going for the edges where it's $5 wide and I collect, 55 cents, risking $4.45 and then get ran over. No way. Those suck. Plus, you don't know when to close them. We've had that stream before where I've demonstrated there is absolutely no way to know when to close a losing credit spread when it's one of those out of the money suckers. And no matter what you choose is bad, right? It is bad all the way around when you try to close them as a loser. That rising wedge got into the 20th percentile and it did not act the way it was supposed to. It's funny how that works. It's an ugly one, but it is a rising wedge. So you can stack the odds in your favor as much as possible by approaching the trading day the way that I laid out in the morning briefing, right? And I know the morning briefing gets false advertising, right? A lot of people show up and they think I'm here to give you a game plan for the day and that I am doing the morning briefing to show you what is on the docket today. That's not necessarily wrong, but that's not what I'm trying to do. I do the morning briefing every day to teach you how to prepare for the trading day. I do the same steps over and over. And the whole goal is to get you to the point where you can do your own analysis before the open without ever needing to catch my live stream because you've built a process to do it for yourself. I tried to make videos to put on the bullish bears years ago and I couldn't. I kept failing because the videos were way too long. They were hours long. And if I didn't make them hours long, I couldn't get all the information in there. And I thought there's got to be a solution to this problem. I need all this information in there. So I finally just decided, screw it. I'm going to do it live every single day, going through the steps, showing people how to do it. And then my consistency would show you the steps, and then you can pick and choose what you want to use for the kind of trading that you want to do. Because day traders got to do it different than futures traders. There is a process, though. So um, try checking out this blog post that I wrote about trading days. And in there, I cover some steps like what to look at, what to look for, and then links to other pages on how to mark out levels, do your top down analysis, and develop a game plan. It's really important that you have a game plan. Otherwise, what I hear from traders is, I was looking at yesterday's high and low, and then ooh, I saw something shiny and a squirrel ran by and I missed it. It ran and I wasn't looking. What happened? I got distracted. I knew I was going to trade it. I had it all planned out, and then I didn't do it. But if you'd have wrote it down in your notes, I'm waiting for price to get to this key level, and when it gets there, I might get a trade. Not I'm gonna get a trade, right? But I want to trade against this level. I just need price to get there. You just writing that down changes things. I don't know why it does, right? It's psychology. We are wired weird, but it does. It changes things. So if you're missing your trades, try laying out your game plan. And you don't have to write a book. None of us have time for that, right? Just something short and sweet. Have a little notepad on the desk with a pen, old school, or type it out on the computer, whatever you want to do on a little notepad of key levels where you're interested in perhaps getting a trade once price gets there. So in this blog post, I lay out all those different parts and pieces and events and levels and FOMCs and all that stuff, right? All the steps. I talk about everything that I do in the morning briefing in this post, all focused on where are we going, writing it out. So I posted the link in the chat. There are additional links like this one, top down charting. When you click that, it'll take you to another page. I've even started to write a little bit of a dictionary or a thesaurus for all the acronyms that we use. And then, just like every day that we talk about, go back in the past. This is really key. Go back in the past and find examples of what you want to trade. Those range days with the iron condors, fake breakout days, days where we run and run and run and we don't stop, whatever it is that you want to trade, find examples of it in the past so that you know exactly what it looks like and what it looks like when it fails. Because when it fails, it gives these warnings. There's things that aren't right to where we're like, yeah, that's not acting right. It's not doing what it's supposed to do. You don't have to wait for a stop. You can just get out because you're like, yeah, no, that is not doing what it's supposed to do. I'm out of here. You don't even need a. I don't want to say you don't need a stop. That's a bad thing to say. You don't need to worry about waiting on the stop, right? You can just get the hell out. What's up, buddy? You got new gray hairs? Yeah. No. Just talking about game plans. Yeah. Unfortunately, the really elaborate ones never worked for me. You know, those really detailed, nuanced plans, they never worked. Yeah, exactly right. I use 111 for a reversal a lot, but that doesn't mean I won't trade against the 1, 2, 3, 6. I just call it the 111. Like, okay, I'm going to look for a fake breakout and I'm expecting it to turn either at 111 or 1, 2, 3, 6, or it might not even hit the line and turn early. And I need to be ready for that too. The plan still is I'm going to reverse that sucker when it gets up there. Broad strokes, right? Having a plan. But I've seen people draw out a plan where they're like, okay, I need the RSI to do this, and I need the MACD to do that, and this Dakota. I'm like, man, you're not going to get all that criteria, and by the time you do, you'll miss the trade. Yeah, I really love a naked chart. I don't mind turning on other things to do some analysis to put, you know, some numbers behind it. But at the end of the day, when nobody's looking and it's just my chart, it's naked. Yep. I wish there was a really good way to get people to use drawings, but you have to grow into it. Every person has to just do them until they find their style, and no book or video can get you there. Yep, they're still in here. That was a wild move on Google, bro. Yeah, that's the key. You know that if you can do it on a two, shoot, you're good. But if you do it on the two and you're like, you know, something's missing, go higher, go lower, go where you need to go to get the rest of the information. Absolutely. Yeah. If I still feel like I'm missing something, I'm gonna keep looking. More data. So when it comes to drawings, You guys want to just keep doing it, doing it, doing it. And if you can go in the past and find old things to draw on, just get so comfortable drawing that you just do it second nature and you don't even think about it. And along the way, you'll build trust in what you're doing and in what you're analyzing. You really will. There's just no way to get that trust except to do the work. At least for me, I couldn't trust anybody if they said, "It works, trust me." Yeah, okay. I don't think so. I really feel let down though. I honestly thought we was gonna get that 64 today. We we missed it by 5 points. SPX 6400, 63.95 and 16 cents. $5, man. This morning? Yeah. Yeah, because it was like, we're gonna go up one more leg. We didn't, but I mean, I'll be right back. I gotta get the dog out before somebody comes pounding on the door. All right, I'm back. You should share your screen, bro. Save you from, yeah, because I got the grandkids showing up about 3 minutes. I had to put the dog out so she didn't start barking. So I'm gonna hop off of here, everybody. Get your weekend started. If you guys got topic requests or questions, whatever, hit us up. Always love having those for Wednesdays and Fridays streams. Heck yeah, morning briefing Monday morning.